If you were born before 1956, you are 70 years old or older right now, and that puts you squarely in one of the most important tax planning windows of your entire retirement. Congress passed a major new tax law last year, and it quietly changed the math behind one of the most powerful retirement moves available, the Roth conversion. If you have a traditional IRA or an old 401k and nobody has walked you through how this new law affects your specific numbers, you could be leaving thousands of dollars on the table, or worse, converting money at exactly the wrong time for exactly the wrong reasons. In this video, you are going to learn exactly what changed, exactly how it affects your conversion strategy, and one specific mistake that turns a smart move into an expensive one. Stay to the end. The fifth item is the mistake that costs retirees the most money, and almost nobody realizes they made it until the tax bill arrives. Before we go further, hit subscribe. Tax law does not sit still, and this is proof. A brand new law passed last year changed the entire calculation behind Roth conversions for millions of retirees, and most people found out from their tax preparer months after the fact, when it was already too late to plan around it for the year. If you are not subscribed, the next change could catch you the same way. Let's talk about Frank. Frank is a retired federal employee in Orlando, 70 years old, 28 years of service before he retired. Frank built up a solid balance in his thrift savings plan over his career, along with a traditional IRA on the side. For years, Frank had heard the phrase Roth conversion tossed around by other retirees at his HOA meetings, but nobody ever explained what it actually meant for someone in his specific situation. Frank assumed it was something only wealthy people with complicated finances needed to think about. What Frank did not realize is that he was sitting in one of the best windows of his entire life to convert some of that traditional money into a Roth IRA at a low tax cost, specifically because he had already retired but had not yet started his required withdrawals. Every year Frank waited without looking into this. He was letting that low tax bracket window close a little further. This is not rare. This happens to retirees across every county in Florida because Roth conversions get talked about constantly among financial advisors and almost never explained clearly to the retirees who could actually benefit the most. Now, before we go further, let's clear up the two objections that are probably already forming in your head. First, this is not just for wealthy retirees with a financial advisor on speed dial. If you have a modest traditional IRA worth $40,000 or $50,000, the exact same conversion math applies to you as it does to someone with $2 million. Second, this is not just for people trying to leave a big inheritance behind. Even if you plan to spend down every dollar of your own retirement savings yourself, understanding how conversions work can still lower your own future tax bill and your own future Medicare premiums. This applies to homeowners, renters, married couples, widows, veterans. If you have any money sitting in a traditional IRA or an old employer retirement plan, this is for you. Here's the first thing you need to know. Last year, Congress passed a sweeping new tax law that made the lower tax brackets many retirees have been living under for years permanent, instead of letting them expire and rise back up the way they were originally scheduled to. This did not eliminate Roth conversions, and it did not change the basic mechanics of how they work. What it did change is the math behind deciding whether converting now actually saves you money compared to waiting. Before this law, many advisors pushed retirees to convert aggressively, warning that tax rates were guaranteed to jump back up soon. That urgency is gone now because the lower rates are locked in for the foreseeable future. But here is what almost nobody explains. Locked in lower rates does not mean conversions stop making sense. It means the decision requires more careful thought instead of blanket urgency, and retirees who are still following old advice built around expiring tax brackets may be converting more aggressively than they actually need to. Here is what to do. If you have been told to convert as much as possible before rates go up, ask your tax preparer directly whether that advice still applies now that the lower brackets have been made permanent, or whether your conversion plan needs to be rebuilt around your actual current numbers. Here is the second item, and this is the single most valuable piece of timing information in this entire video. If you have retired but have not yet started Social Security, and you have not yet reached your required minimum distribution age, you are sitting in what is often called the trough years, the lowest taxable income window of your entire retirement. During these years, without a paycheck and without RMDs forcing money out of your accounts yet, converting money from a traditional IRA to a Roth IRA can happen at a far lower tax rate than you will likely face once RMDs and Social Security both kick in and stack on top of each other. Once your RMDs begin at either 73 or 75, depending on your exact birth year, that forced income can push you into a noticeably higher bracket every single year going forward, whether you need the money or not. Converting during the trough years, even in smaller amounts spread across several years, can shrink the size of those future required withdrawals and keep you in a lower bracket permanently. Here is what to do. If you are retired and have not yet started Social Security or reached your RMD age, ask a CPA to calculate your current marginal tax bracket and ask specifically how much you could convert this year while staying inside that same bracket without spilling into the next one. Here is the third item, and this is the mistake that quietly punishes people who do not plan carefully. Every dollar you convert from a traditional IRA to a Roth IRA counts as taxable income for that year, and that income does not just affect your tax bracket. It also affects your Medicare premiums 2 years later through something called IRMAA, the income-related monthly adjustment amount. Converting a large chunk of money in a single year can push your income just over an IRMA threshold, and that can mean paying substantially more for Medicare Part B and Part D for a full 2 years, even if your income drops right back down the following year. This is one of the most common Roth conversion mistakes, converting too much in one calendar year and accidentally triggering a Medicare premium increase that eats into the very tax savings the conversion was supposed to create. Here is what to do. Before converting any amount, ask your tax preparer to check exactly where the nearest IRMA threshold sits based on your filing status, and make sure your planned conversion amount stays safely below it. Here is the fourth item, and this is specifically for anyone with money in more than one IRA, including old rollover accounts from jobs you left decades ago. If you have both pre-tax money and after-tax money spread across multiple traditional IRAs, the IRS does not let you choose to convert only the after-tax portion. Instead, a rule called the pro rata rule forces you to treat all of your traditional IRA money as one combined pool, and any conversion pulls out a proportional mix of taxable and non-taxable dollars based on that entire pool, not just the specific account you are converting from. Many retirees who have rolled over multiple old 401k accounts over the years do not realize all of those accounts get combined for this calculation, and they end up owing more tax on a conversion than they expected. Here is what to do. Before converting anything, ask your tax preparer to calculate your pro rata percentage across every traditional IRA you own, including old rollovers, so you know exactly what portion of any conversion will actually be taxable. Here is the fifth item, the one we told you to stay for, and this is the mistake that costs retirees the most money of anything in this entire video. A Roth conversion is permanent. Once the money moves from your traditional IRA into your Roth IRA, there is no undoing it, no reversing it, and no recharacterizing it back the way there used to be years ago. That rule changed permanently back in 2017, and many retirees still do not realize recharacterization was eliminated. This means if you convert a large amount and then discover later in the year that it pushed you into a higher bracket than you expected, or triggered an IRMAA surcharge you did not plan for, you are simply stuck with that outcome. There is no do-over. Here is what to do. Before finalizing any conversion, especially a large one, run the numbers with your tax preparer using your actual expected income for the full year, not an estimate from months ago, and confirm the amount before December 31st. Because once the conversion happens, it cannot be reversed no matter what the rest of the year brings. Let's bring this together. Ask whether old advice about converting aggressively still applies now that lower tax rates are permanent. If you are in your trough years between retirement and RMDs, find out how much you can convert while staying inside your current tax bracket. Check where the nearest IRMAA threshold sits before converting anything, so you do not accidentally spike your Medicare premiums. If you have multiple IRAs, calculate your pro rata percentage so you know what portion of a conversion is actually taxable. And remember that every conversion is permanent, so confirm your numbers carefully before December 31st, because there is no reversing it afterward. This video is for general information only. It is not personalized tax or financial advice, Every retirement account, every income situation, and every family's numbers are different, and a CPA or financial advisor should review your specific numbers before you convert anything. But now you know exactly what to ask them. If this video helped you, do not keep it to yourself. Send it right now to one person you love who is over 65. A poorly timed Roth conversion can trigger higher taxes and higher Medicare premiums that last for years, and most retirees only find out after the damage is already locked in. Florida Senior Money exists so that never has to be how you find out. Subscribe, stay sharp, and we will see you in the next one.